I do my best to teach you something you may not know about finance, something that's useful and will make you a better investor. Today, I'm going to show you precisely why stocks have been a terrible investment in general over the past decade. Once you understand one certain factor in the value of stocks, you'll never invest the same way again. Before I get started, people aren't taught, they only learn. Until you recognize the value and importance of learning the basics of finance, you'll never read these messages carefully or internalize their meaning. Why do I say this? Because it's the truth. You can learn anything if you choose to. Nothing in life is simple. However, pain sometimes seems to be the best way to learn. After all, it is only one choice of how we learn. The chart below shows you the price-to-book ratio of the S&P 500 over the last decade. The S&P 500 is a list of stocks published by credit ratings agency Standard & Poor's, or S&P. It is essentially the 500 largest and most successful companies in the United States. This list of stocks is also commonly used as a way to reference the entire stock market. It's comprised of stocks from every sector of the marketplace and is thus representative of the stock market as a whole. The book value ratio is easy to understand. Book value is one simple measure of a company's net assets. The book value ratio simply refers to the ratio of dividing a stock's total market value, the total value of all its shares, by its book value. This measure gives you a rough idea of whether stocks are expensive, overpriced relative to their assets, or cheap, and thus attractive for investors. The lower the book value ratio, the better the value. As you can see on the chart below, the average book value of the S&P 500 has gone from nearly 5 to around 2. In the above chart, you can see that stocks were extremely expensive back in 2000. They've been getting cheaper ever since. Most investors didn't realize back in the late 1990s and early 2000 that stocks were trading at multiples of net assets and earnings that were more expensive than they'd ever been before. Ever. So why is this important now? Most investors lost money in stocks over the last decade because they've been holding stocks that on average have been getting cheaper relative to the underlying intrinsic value of the businesses they represent. Take Walmart as one example. In 2000, shares of Walmart peaked at $70 a share, when it was trading for more than 50 times earnings. Since that time, the share price has basically gone nowhere. Today, the share is traded for a little less than $60. Meanwhile, the value of the underlying business has soared. Last year alone, Walmart produced $23 billion in cash earnings, bought back $14 billion in their own stock, and paid out more than $4 billion in cash dividends. If Walmart still traded at 50 times multiple, the company would be worth nearly $1 trillion today instead of only $200 billion. People, by and large, are not going to do well in stocks until the market's average multiple begins increasing again. That is, until investors are willing to pay higher prices for their stocks. The returns on a portfolio of stocks are likely to be marginal and probably not worth the risk. Today, unless people are willing to speculate and hedge, they shouldn't even own stocks. Investors as a whole have been unwilling to pay for more stocks for one good reason. They don't trust the current monetary system, which has suffered crisis after crisis. Investors have no way to know what's coming next in the world economy because the monetary system itself is so fragile. As a result, they're extremely reluctant to pony up for future earnings. The stock market's average multiple, how much people are willing to pay for stocks, is a measure of investor confidence. Confidence keeps falling because the fundamentals keep getting worse. European countries are at risk of default. America continues to run enormous $1 trillion plus annual deficits. Central banks around the world have begun to flee the U.S. dollar standard, returning to gold. There's a profound lack of confidence in American current political leadership on both sides of the aisle to improve business climate. Most investors seem to be waiting for the next shoe to drop. As you know, my position is that they are smart to worry. The situation leaves most investors in a terrible position. They can't earn a good return in stocks because the volatility and the gradual but continuing decline in the market's average multiple. The result is, even when earnings go up, stock prices don't. Most bond yields are too low to live on, and most stock dividends are also. If you're not earning capital gains and you're not making good income from coupons and dividends, what can you do? The unfortunate reality is that in a crisis, and yes, we're in one, the best you should realistically hope to do is protect your money. The first rule of investing is to protect your principal. Again, I say, protect your principal. That's why I've been urging people to stop thinking growth and start thinking income strategies. Personalized, strategic, growth-oriented income strategies have outperformed growth only for more than 20 years. In fact, not one of my clients has lost a dime in the market in over a decade, and I can prove it. We've done extremely well, better than I expected with this strategy. This is the best way to grow your money, create income, and stay liquid, so that you'll keep your purchasing power and have ready cash to invest when this crisis reaches its final massive liquidating panic. No, I don't know when that will happen, but I know it will happen, and you will definitely recognize when it does. I've been trying to really educate people about how to preserve and grow their wealth safely, especially folks who are retired, because that's one of the best ways to generate income right now. Investing in a market like this one, with a declining multiple and lots of volatility, is a sure way to lose money in the Wall Street casino game. How much of your retirement would you risk in Vegas? What rate of return is worth risking your life savings? 5, 8, 10, 20%? If losing a portion of your life savings would lower your standard of living, can you afford to risk any of it? What if a respectable rate of return could be guaranteed without risking principal? It is possible to guarantee from 4 to 8%. We have insured our cars, homes, health, and life. Many people don't know it's possible to insure your portfolio's rate of return. What is the one thing a person must have in order to permanently retire? Income, income, income. Every day I hear people say, "I'm tired of this roller coaster market. I want out." To those who want to get off the Wall Street roller coaster and are looking for smarter retirement strategies, there is hope, and I can help. I show people how to create passive streams of income that allow them to live worry-free in their world. Imagine having guaranteed income for life, regardless of market conditions. Bull or bear, we don't care because the income is guaranteed, like a pension. I'm in the business of creating private pensions, and because of that, my clients live in worry-free, peaceful lifestyles. Everyone should have a smarter strategy in place that guarantees safe, consistent, guaranteed income for the rest of your life. Most people haven't recovered from the market crash of 2008. If you really want a smarter retirement strategy, one that will win the retirement race, then please click on the Schedule an Appointment button to set a time to meet with us. Thank you.